All right, let's dive in. Today, we've got a real financial detective story for you. It's about a discovery that seemed to break one of the fundamental laws of the financial universe. It's the story of a hidden pattern in the stock market that was, believe it or not, sitting there in plain sight for decades. So let's kick things off with the million-dollar question, right? Is the stock market predictable? For the longest time, the smartest people in the room had a very clear and simple answer. Nope, absolutely not. Trying to predict it was a fool's game. You see, the old rule, the established theory, was that stock prices are completely random. What a stock did yesterday gives you exactly zero information about what it's going to do tomorrow. But then this tiny, nagging question started to bubble up. What if that's not the whole story? What if trends, what if momentum is actually a thing? And that one question set the stage for one of the biggest discoveries in modern finance. To really get why this was so controversial, you have to understand this core belief called the random walk. Think of it like flipping a coin. Does the last flip tell you anything about what the next one will be? Of course not. And that's exactly what they thought about stock prices. The past was totally irrelevant. Now, this idea has a fancy academic name: weak form market efficiency. All it really means is that any past price info, all those charts and patterns, is already baked into today's price. So trying to use the past to predict the future, totally pointless. This was basically financial gospel, until a couple of researchers decided to commit a little heresy. And this is where our detectives enter the scene. Back in 1993, two researchers, Jegadeesh and Titman, asked a question that was so simple it was radical. They basically said, hey, what if winners just keep on winning? And what if losers just keep on losing? I know it sounds almost childishly obvious now, but based on everything the experts believed, a strategy built on that idea should have been a complete and utter failure. So what they do, their method was just beautiful in its simplicity. First, they took a whole bunch of stocks and just ranked them based on how they'd done over the last few months. Then they split them into two groups: the top 10%, the winners, and the bottom 10%, the losers. And here's the clever part. They'd buy the winners and short sell the losers. This created what's called a market-neutral portfolio, which is a fancy way of saying it was designed to ignore the overall market's movement and just isolate one thing, and one thing only: momentum. Now, the devil is always in the details, right? They used a huge data set spanning 24 years, and they stuck to the big exchanges, so no weird, tiny stocks could skew the results. But here was their real stroke of genius. They put a 1-week gap between when they ranked the stocks and when they actually traded them. Why? This little trick made sure they weren't just catching some weird one-day market hiccup. They were hunting for a real, sustained trend. Okay, so the stage is set. They've got a strategy that every textbook on the planet said was a dead end. They're basically testing the financial equivalent of the law of gravity. And what they found? Well, it wasn't just a small crack in the theory, it was a bombshell. So what did the numbers say? The strategy generated an average profit of about 1%. Now hold on. That might not sound like a lot, but it was 1% per month. In the world of finance, a consistent, predictable 1% monthly return is, it's the holy grail. It's the kind of thing that it shouldn't exist. And just to put that number into perspective, look at this. The momentum strategy, that little 1% a month, consistently blew the average market return out of the water. This wasn't some tiny rounding error they found. It was a massive, blinking neon sign that said, hey, the way you think the market works, it's wrong. Okay, so whenever you see outsized returns, the first thing everyone says is, but it must be riskier, right? Maybe these winning stocks were just, more volatile or something. But Jegadeesh and Titman were way ahead of that. They checked, and as they wrote right here in their paper, the profits were not because of higher risk. In many cases, the winning stocks were actually safer than the losers. So the plot thickens. And this effect, it had a life of its own. It was really strong for about a year. Then, in year 2, it would start to fade away. And then, and this is the wild part, over the next 3 to 5 years, it would completely flip on its head. The original losers would actually start to outperform the original winners. Now, people kind of knew about that long-term reversal, but this powerful short-term momentum, that was the brand new, game-changing discovery. So, if it's not risk, then what in the world is causing this? Well, the investigation had to shift gears. It moved away from the hard numbers and started looking at something a lot messier: the human brain. Okay, culprit number 1, the underreaction hypothesis. Think about it. When a company announces amazing news, theory says the stock price should instantly jump to its new correct value. But what if people are slow? What if the good news kind of trickles into the market's consciousness over weeks or months? That gradual upward drift as the price plays catch-up? That is momentum. And then there's culprit number 2, something we can all probably relate to: good old-fashioned overconfidence. You know the feeling. An investor makes a good call on a stock, and suddenly, they're not just lucky, they're a genius, right? They think they've got the magic touch, so they double down. Then other people see the price going up and jump on the bandwagon, and suddenly you have a full-blown trend that's pushing the price way past what it's actually worth. But if you need a smoking gun, a single piece of evidence that this is all about human behavior, here it is: the January exception. This momentum strategy worked like a charm in every single month of the year, except for January. In January, everything went haywire, and the losers crushed the winners. So why? The best explanation is tax loss selling. People sell their losing stocks at the end of December to get a tax deduction. This pushes those prices down artificially. But come January 1st, that selling pressure is gone, and those stocks snap back. That's not a market force, that's a human, calendar-driven behavior, plain and simple. So when the dust settled, what was the legacy of this one paper? I mean, this wasn't just some interesting little finding. It truly changed the rules of the game. The impact was just massive. It was a huge body blow to the old efficient market hypothesis. It proved that momentum was a real, legitimate market factor, putting it on the same level as classic factors like value and company size. This didn't just inspire new ways to invest. It basically gave a giant stamp of approval to the entire field of behavior finance. It proved that psychology wasn't just some soft, fuzzy idea. It's a powerful, predictable force in financial markets. But, and this is a big but, let's not get carried away. This isn't some magic formula for getting rich. When you try to do this in the real world, you run into some serious problems. First, the strategy requires tons of buying and selling, and that racks up transaction costs that can eat away your profits. Second, shorting those loser stocks, it can be really hard and expensive to do. And maybe most important of all, momentum has a dark side. It's known for having these rare but absolutely brutal crashes when the market sentiment suddenly flips. A fair question at this point is, okay, but maybe this was just a weird fluke in the US market during that one period. Well, researchers all over the world decided to find out. And guess what? They found the exact same effect in Europe, in most of Asia, and in all the years since the original study. It's a real global phenomenon, with one really weird exception: Japan. For reasons nobody can fully explain, momentum just doesn't seem to show up there. So if you take one thing away from all of this, let it be this: the discovery of momentum was proof that markets aren't just these cold, calculating machines running on pure logic. They are deeply, fundamentally human. They're driven by our biases, our fears, our slow reactions, and our overconfidence. And it's that human element that creates these incredibly powerful and surprisingly persistent patterns. And that leaves us with a final and kind of tantalizing question. Think about it. This incredibly powerful, obvious pattern was just sitting there in the data for decades, hiding in plain sight, just waiting for someone to ask the right question. It really makes you wonder, what else is out there? What other simple, game-changing truths about how all of this really works are still just waiting to be found?